Hello, friends, and welcome back to Money Girl. My name is Laura Adams. If you're new here, welcome. I'm an award-winning personal finance author who's been writing and hosting this show since 2008. If you're an existing or budding business owner, don't miss my latest title, which was an Amazon #1 new release. It's called Money Smart Solopreneur, a personal finance system for freelancers, entrepreneurs, and side hustlers. And hint, hint, it would also make a great gift for the aspiring entrepreneur in your life. The mission here is to help you get the knowledge and motivation to prioritize your finances, build wealth, and have more security and less stress. When I'm not podcasting, I work with brands as their on-camera spokesperson, PR consultant, and multimedia content creator. If you want to learn more about my books, money courses, or how to work with me, please visit my personal site, lauradadams.com. If you've been listening to the show for a while, you probably know that I love retirement accounts. And that's because they allow you to accomplish two critical things simultaneously: building wealth and cutting taxes. But various account rules can change from year to year based on what's happening in the economy, like inflation. And since we've had higher prices and they seem to be sticking around, it's not surprising that the IRS is adjusting rules for next year to be more favorable. And it's really essential to stay on top of any annual retirement account adjustments so you can use them to save more money. So stay with me if you want to grow a bigger nest egg and pay less tax. This show will cover 7 retirement account changes coming in 2023. And real quick, before we get started, if you're enjoying Money Girl, please subscribe and give it a 5-star rating and review so we know you're getting value from this free content that we love bringing you. All right, let's get into the details on the new retirement changes and how to use them starting January 1, 2023. All right, the first change is having higher contribution limits for workplace retirement accounts. So starting in 2023, if your employer offers a retirement plan, such as a 401k or a 403b, the base amount you can contribute is going up. It's increasing from what it is right now, which is $20,500 to $22,500. And that same adjustment applies to most 457 plans and thrift saving plans, or TSPs, if you work for the federal or local government. However, if you have a simple retirement account, the base limit and the increase are smaller. It's going from $14,000 now to $15,500 in 2023. These new limits apply to contributions to traditional or pre-tax accounts and Roth or post-tax accounts. Remember that traditional contributions cut your taxes in the current year, and they grow tax-deferred until you make withdrawals in retirement. But Roth contributions work very differently. They get taxed up front, but you take them and all of your earnings entirely tax-free in retirement. Note that if you have a Roth at work, there are no income limits to qualify. A lot of people get confused by that because there are income limits with a Roth IRA, and we're going to cover them here. Workplace retirement accounts also have overall limits that include employer contributions, like the money your company is putting in for matching. And in 2023, those are going up. They're increasing from $61,000 to $66,000. And if you're over age 50, you get a little bit higher amounts. They're going from $67,500 to $73,500. Remember that you can make changes to your retirement plan at any time during the year. And in most cases, you can set a higher contribution rate to begin at a particular time or date. Like, every January 1st, you increase your contribution by 1%. So make a goal to max out your retirement plan right now by updating your contribution percentage or the dollar amount that you're putting in per pay period for 2023 and beyond. Okay, the second change for 2023 is having higher catch-up contributions for workplace retirement accounts. When you're over age 50, you qualify for additional contributions that are called catch-ups, and these apply to your 401k, 403b, and most 457 plans, as well as the federal government's TSP. They will be $7,500. That's up from $6,500. So you're getting an extra $1,000. And if you're over age 50 with a simple plan, your catch-up is increasing to $3,500, and that's up from $3,000. So that means most participants over 50 will be able to contribute $30,000 starting in 2023. Here's the math. You're getting that base contribution of $22,500 plus the new catch-up contribution of $7,500 for a total of $30,000. And those with a simple can contribute a total of $19,000. That's $15,500 plus the catch-up of $3,500. All right, the third retirement change is having higher contribution limits for self-employed retirement accounts. A SEP IRA and a solo 401k are two popular self-employed retirement plans. I have a SEP IRA. And for 2023, the maximum that business owners can put in either plan is going up. It will be $66,000, and that's up from $61,000. However, unlike SEP IRAs, solo 401ks allow catch-up contributions. That gives those over 50 a maximum contribution of $73,500. So that's $66,000 plus the catch-up contribution of $7,500. That is excellent news for solopreneurs and small business owners who want to save more for retirement. The fourth change is having higher individual retirement account or IRA contribution limits. While IRAs don't allow you to contribute as much as employer-sponsored plans, which is why I always encourage you to max out those employer plans first, they are available to anyone with earned income, regardless of age. After several years of no increases to IRAs, finally, the IRA contribution limit is going up. It's going to be $6,500. That's up from $6,000. However, the catch-up for IRA contributions for those over 50 is not going up. It's not going to be adjusted. It remains at $1,000. So qualifying individuals over 50 can put up to $7,500 in either a traditional or a Roth IRA, or you can split your contributions between the two types. Note that there are income limits for Roth IRA contributions, though, and we're going to cover them in just a moment. The fifth retirement change for 2023 is higher income thresholds for deducting traditional IRA contributions. Now, this may get a little complicated, so stay with me. This is only going to apply if you or a spouse have a traditional IRA and you qualify for a retirement plan at work. But if not, if you or a spouse only have a traditional IRA, your contributions are fully tax deductible up to the annual limit. However, if you or your spouse have a retirement plan at work and you've got a traditional IRA, that deductibility on the contributions may be reduced or eliminated depending on your income and your tax filing status. So let's go over those. Here are the new modified adjusted gross income thresholds for 2023 when you contribute to a traditional IRA and a workplace retirement plan in the same year. If you're single and you've got income between $73,000 and $83,000, you're going to qualify for a reduced deduction, and you get no deduction for those traditional IRA contributions when your income exceeds $83,000. Now, if you're married and you file taxes jointly, when you've got household income between $116,000 and $136,000, that's where you get a reduced deduction, but you get none when you exceed $136,000. Now, there might be a situation where, let's say, you do not have a workplace retirement plan, but your spouse does. And if you've got a traditional IRA, that could affect you. So in that case, you would get a reduced deduction for your contributions when your household income is between $218,000 and $228,000, and you'd get no deductions for those IRA contributions when your household income exceeds $228,000. Now, I know this is complicated, and I want to reiterate that these income limits do not apply if neither you nor your spouse is covered by a retirement plan. If all you've got are IRAs, in that case, you can always contribute to a traditional IRA and get that full tax deduction. All right, the sixth change is higher income thresholds for making Roth IRA contributions. So we're going to switch gears. We're going to talk now just about Roth IRAs. And just like traditional IRAs, the 2023 Roth IRA contribution limit is going up. It's going to be $6,500. Or if you're over age 50, you're going to get the catch-up contribution of $1,000 for a total of $7,500 for 2023. Remember, with a Roth, your contributions are never tax deductible because you do have to pay tax on them up front. However, unlike a traditional IRA, as I previously mentioned, annual income limits exist to qualify for Roth IRA contributions. It's really the only account out there where your income, makes a difference on whether you qualify or not. But fortunately, those income thresholds are going up for 2023. So here are the new income limits by tax filing status for Roth IRA eligibility in 2023. If you're single and you've got income between $138,000 and $153,000, you can make a reduced Roth IRA contribution. But you can make no contribution when your income exceeds $153,000. So that may mean that some of you are now eligible for a Roth IRA when you were not eligible previously. So definitely take a look at that. And if you're married and you file taxes jointly and you've got household income between $218,000 and $228,000, you get a reduced contribution and none when you exceed $228,000. So again, take a look at your household income and, you may be able to qualify now for a Roth IRA when you didn't before. The higher income limits are terrific because more people will qualify for these valuable accounts. And again, they're so valuable because you get to skip taxes on maybe decades of investment growth and get tax-free income in retirement. And note that you can max out both a Roth IRA and a workplace retirement plan with no conflicts. Unlike the traditional IRA where, you do have to qualify for deductibility, because Roth IRAs are non-deductible, there's no conflict with also having a retirement plan at work, either for yourself or your spouse. All right, the seventh and final retirement change we'll cover for 2023 is higher income limits for claiming the Retirement Savings Contribution Credit. This is also known as the Saver's Credit, and basically it's just a tax benefit to encourage low and moderate income workers to save more for retirement. It matches some of what you contribute to an IRA or a workplace retirement plan. So you qualify for the Saver's Credit if you're single, or let's say you're married and you file taxes separately and you've got income up to $36,500. So that's a little higher than it was previously. But just note that if you've got income, up to $36,500, you're probably going to qualify for the Saver's Credit. And married couples filing jointly, when they've got household income of up to $73,000, they qualify for the Saver's Credit, and those filing as heads of household qualify with income up to $54,750. Okay, so those are the amounts that are slightly elevated for 2023. I know this has been a ton of numbers thrown at you, and always go back and listen to the podcast again or look at the transcript for the show if you really want to, dial into specific numbers that might apply to your situation. While this isn't a complete list of every retirement-related tax change coming in 2023, I hope it helps you understand what accounts, tax deductions, and credits you can take advantage of next year. As always, you can leave a comment or a money question by calling 302-364-0308 and leave a voice message. Or feel free to send me an email using my contact page at lauradadams.com. That's all for now. I'll talk to you next week. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. It's audio engineered by Steve Rickyberg with editing by Adam Cecil. Our podcast and advertising operations specialist is Morgan Christensen. Our digital operations specialist is Holly Hutchins. Our marketing and publicity assistant is Davina Tomlin. And our intern is Cameron Lacey.